Welcome to this edition of the Capital Brief. I'm Seth Berenzweig here in our BLC Digital Strategy Studio in Tysons, Virginia, here with our friend and colleague John Tamny. John is a national author, columnist, vice president of FreedomWorks, and as we'll talk about shortly, is also working on a new book. John, how you doing?
Great. Good to be here. Good
Great.
to be back.
Fantastic. Back from our short summer break, and we're jumping in today to what is really the talk of the financial town, the talk of Washington, D.C., and nationally, the Fed and its so-called fight against inflation. And, you know, John, one of the things that I want to do in our conversation today is I want to take a little bit of a different path because I want to challenge some of the really monochromatic conversations about the constant drumbeat of the assumption that the Fed is doing the right thing, should be doing the right thing, has a direct connect to the gas and the brakes, so to speak, and that they're here to save the day. John, let's talk a little bit about really taking a step back and letting our viewers and our listeners just kind of take a 30,000-foot view. Talk to us about what is the assumption in the popular media about what are the Fed's powers here, and is that assumption right or wrong?
The popular media believes that the more that Americans are working and prospering, that causes inflation, as in our jobs are going well, there's limited supply of labor, and as a consequence, the price of labor is going up, we run out of capacity, this causes inflation.
We get too hot.
We get too hot, which is laughable. That's the equivalent of the coach of the Tampa Bay Buccaneers saying, well, you know, Tom Brady threw three touchdown passes in the first quarter. Let's bench him lest he throw a fourth in the second quarter. I mean, what can you ever improve too much at your work? Is there something that you'd want to put a break on with yourself? Obviously not. Yet the view is that an economy of individuals needs to be slowed down by the central planners at the Fed.
Okay, so the old school economists, the graybeards, would come in and say, John, hold on a second. The way that we would push back on that theory is to say, what about so-called sticky inflation? What about the fear of $8 gas? What about the fear of, like, you know, your groceries costing prices that are out of control? Is an overheating economy, pardon me, something that's going to create runaway prices, and that therefore the Fed is simply here to save the day?
That's the common view, and it's defined by a misunderstanding of history. What is inflation? Inflation is a devaluation of the currency. Mm-hmm. It's not too many people working. Germany, after World War I, where the mark fell to 1/4 billionth of a dollar, didn't have a problem of too many people prospering. They had a problem of the currency being destroyed. We saw that in Argentina. We've seen that in Zimbabwe in modern times. We saw it in the United States in the 1970s. We saw it again, I would say, in the first and second decades of the 21st century. When you devalue the currency, that is inflation. So they have redefined it. It's like saying, well, excellent means great, but today it means it sucks. It's creating an all new definition where it didn't exist.
So then what is the Fed trying to do, which you think might or might not be, you know, fiction or science fiction? What are they trying to do in some kind of a conventional sense in their way to get, you know, to have their so-called inflation busting strategy to grab control, and what's wrong about that strategy?
Well, it's rooted in the laughable notion that the U.S. is a closed economy. Mm-hmm. That if the Fed raises the overnight rate that banks, which are just a microscopic portion of total credit, which you know well in your present job,
right,
that if it somehow raises that rate, that's going to limit the flow of credit in the U.S. economy.
And somehow the flow of growth.
Yeah, the flow,
right.
And so that will put people out of work, and so
right.
that will push down demand, and it will bring down inflation. Well, for one, credit is produced around the world. We borrow money for what it can be exchanged for, and so the notion that the Fed could limit the flow of borrowing in the United States is laughable. What it closes down is going to be made up by myriad non-bank financial sources, and we see this already.
Sure.
But the bigger thing than that is that's not inflation. Inflation is a devaluation of the currency, which, let's be clear, that has never been part of the Fed's portfolio. Let's just do brief history here. In 1933, FDR devalued the dollar from 1/20th of a gold ounce to 1/35th. Fed Chairman Eugene Meyer begged him to not do it. He was so incensed he resigned over it.
And you're talking also about the era of the modern creation of the Fed, right?
Yeah, the Fed was created in 1913, but it was powerless 20 years later to stop a devaluation of the dollar. Fast forward to 1971, President Nixon to delink the dollar from gold. Love or hate the gold standard. I'm not here to change people's minds on that matter, at least this show. But he did it, and Fed Chairman Arthur Burns begged him not to do it. He was once again powerless to do it. So we're talking about the Fed fighting inflation. The Fed doesn't even have control, doesn't even have oversight of the dollar's exchange rate. How can it fight a dollar phenomenon if that's not even part of its policy portfolio?
But if one of the inherent aspects of inflation is the mechanic of more dollars chasing less goods, so that you end up with, like in Weimar Germany, people having to wheelbarrow in all of their money to be able to afford a loaf of bread. Why isn't the Fed's control of the money supply feature directly relevant to getting a handle on that problem?
Because the Fed doesn't control the money supply. Again, and how we know that is that the dollars are around the world. If you want to transact in Venezuela right now, you better have dollars. If you want to buy something of value in North Korea, you better have dollars. This describes Iran. This describes Zimbabwe. Did the Fed put money supply in these countries? No. Money is wherever it's needed, wherever there's production. A little or a lot, there will be a little or a lot of money. And so the idea that the Fed controls it is laughable. No. The markets set money supply, and money supply is a consequence of production.
Well, and availability of purchasing power is directly a function of the availability of credit. And as we know, and as you alluded to a moment ago, as part of our transactional practice here at the law firm, in order to be able to grease the wheels of progress on a lot of these deals, you get private equity financing. Jerome Powell has nothing to do with these deals. You have a whole bench of private lenders that come in and have their own negotiating powers. And there's different fluctuations in terms of the status of private equity and deal flow and things like that. But the Fed doesn't control that. So to the extent that there's available credit that's made and companies are negotiating on financing for deals and acquisitions and growth, that, to your point, shows that purchasing power is not controlled by a bunch of bureaucrats in Washington. It's controlled by the private markets, which is something that should be. But if there is much folly to the Fed's strategy and that it's something that is at least to a large extent misdirected, then we're really witnessing something that is avoidable consequences of a lot of wealth destruction. Because if you take a look at what's happening now in the stock market, there is massive destruction across the board of equity values in the stock market. There's such levels of panic right now that there's not even any deleveraging. When you take a look at Bitcoin, which is supposedly a store of value, even gold itself, there's no delinking. It just seems like everything is just falling flat down. So where are we heading with this right now? I mean, we've had 4 rate increases in the last 6 months. We're going to have more increases, and it's going to continue at least through the end of the year. If this is something that's a fundamentally flawed strategy, what's the upside on the risk factor?
Well, I'll start it by replying to one that you brought up, Bitcoin and gold. Isn't it interesting that the inflation hawks that are everywhere and have always been there, that have claimed that the world is ending for as long as you and I have been alive, they said, well, the introduction of Bitcoin, that's the store of value against these awful central bankers, and they're so powerful and everything.
Right, the new store of value.
Well, what happened then? Because Bitcoin was 68,000 in 2021. What is it now? Would your theories, maybe not you, but in general, the hawks out there, if you think there's inflation right now, you're rethinking that, at which point we go to gold. Gold has historically been the best way of measuring the dollar's value. Gold is down during the Biden years. This isn't me defending Joe Biden, But it is me saying, if this is inflation, this would be the first inflation in the history of mankind in which the dollar rose against foreign currencies and rose against the objective measure that's gold.
Because the dollar is still relatively strong.
It's in a modern sense, it is. Since Biden got into the office, the dollar has been strong. In the 21st century sense, it's been pretty weak. But that was, presidents get the dollar they want. George W. Bush oversaw a massive devaluation of the dollar that no one seems to want to discuss today. Barack Obama continued it. And so, bringing it back to the Fed, I reject the notion that the Fed moves markets. I know that that's the commonly held view, but the reality is, if that's true, if that were true, if the Fed could lift the stock market by raising rates or lowering rates, well, what happened in the early 2000s? What happened in 2020? Stocks fell. If the Fed could prop up stocks, the U.S. economy would be so destroyed as to not be worth discussing. It's my speculation that the weak stock markets right now have nothing to do with the Fed. These interest rate hikes have been priced forever. The markets have known about them forever. The Fed always wants to do something. It's a bureaucracy in search of a purpose, so it does these things. But to your exact point, you live in the real world, and you know that what the Fed does isn't terribly relevant to the deals you help finance.
Yeah, the deals that we're getting financed in the M&A space based upon fundamentals of the strength of the companies and the eagerness of these private lenders to come in and seek upon their own private terms in terms of how they want to finance this deal. But yet, rather than letting the private market guide its own course, there seems to be some kind of a sad irony in the fact that we're now viewing as saviors the same bureaucrats in Washington that arguably may have put us in this place to begin with. We had all of this stimulus that was going on. The federal government writ large were keeping rates very low, continued to buy back securities, and had this very permissive environment. There's really a question in my mind as to the credibility of the system that we're relying on now, when a lot of the same bureaucrats that we're relying on might have had a hand in a lot of the policies that led to some of these instances that put us exactly where we are right now. One of the other examples of where Washington should just back off and let the private markets find their own way and learn their own lessons is arguably in the cryptocurrency market. You and I have talked a little bit about cryptocurrency in the past, and you've opined, and I've agreed with you, that the stumbles in the crypto world are fine. They're normal market occurrences where if you let the markets learn from their lessons, it will result in greater maturity and greater knowledge, not only institutionally, but also in terms of the American retail investor. There have been some really serious stumbles that have been ridiculous. There have been some crypto players and crypto lenders like Celsius that is in bankruptcy right now, which just had a great strategy and fumbled, but that will be a lesson to other crypto authorities and companies that can come in and hopefully do a better job. So the bottom line that I'm making is that we need to rely less on bureaucrats in Washington and just let the market and the people who are the capitalists just come in and do their job.
There's no doubt. I mean, it's the irony of ironies, but it's not. It's what we've always known, that Washington is the one place where you can stumble and then get more money to fix what you did wrong. And so now I would say in this case that the Fed had nothing to do with this inflation. I don't think that the Fed fiddling with rates has anything to do with inflation. Inflation is a dollar phenomenon. It's a choice to devalue or not. If President Biden wanted to end the inflation, he would get on TV with Janet Yellen and say, we would prefer a stronger, more stable dollar, and watch how quickly markets would give him exactly that.
So in other words, if Biden listens to this podcast, and we all know, of course he should.
He does.
Of course he listens to it. Yeah. What would you tell him needs to change in order for there to be price stability and market prosperity? What's the smart way to do it, rather than us just sitting around like a bunch of robots listening to mainstream media talk about whether we're going to go up 75 or 100 basis points? How should it be done?
I would start with this inflation. These higher prices of today have nothing to do with you. They have everything to do with lockdowns from before you were in office that eviscerated the division of labor that leads to lower prices in the first place. The miracle was the prices that prevailed before the lockdowns.
Right.
That they're higher today is a statement of the obvious. You can't destroy trillions of commercial relationships around the world or compromise them and expect prices to remain the same. So stop focusing on inflation. These are higher prices. There's an ocean of difference between higher prices and inflation, at which point presidents get the dollar they want. If you are concerned about inflation, you can fix it between breakfast and lunch. As president, you can say, I'd prefer a dollar that buys $1.20 in euros. I'd prefer a dollar that buys 1,500 a gold ounce. Pick your measure and stick to it, and watch the markets correct the dollar upwards.
Right.
If you want to fix inflation, you fix it by strengthening the currency.
What is your upcoming book talking about? The reason I mention this is because, first of all, I'm a big fan of your books, but secondly, it's directly relevant to what we're talking about right now. You have a book coming out in about a month that's relevant to this subject matter. Can you just tell me what is the book, and what is the thesis as it applies to what we're talking about today?
It talks a lot about, you talk about private equity and the M&A deals that this one focuses a lot on Silicon Valley, which if the Fed's not relevant to private equity, imagine Silicon Valley, where there's no debt finance, where it's all equity finance. The business model is equity finance because just about everything fails.
Right.
The notion that the Fed fiddling with rates has anything to do with the most dynamic sector of the U.S. economy is laughable. So it makes that point, but it broadly makes the point that money supply is as natural as the goods that we wear, these right here. Wherever there's production, there's always going to be money, no matter what, and central banks can't do anything about it. And so it makes a broad case, just to use one example. Much of China's growth 2 centuries ago and China's growth now was financed in the 20th century by 2 Jewish financiers from Iraq who decided there's major growth to be had in China. In modern times, China's growth is financed by U.S. entities, even though it's illegal for them to be doing it. Even though it's illegal for U.S. entities to own a lot of Chinese companies. And so my point, the broad
Even
point,
though after this show I could go to my computer, I can
precisely.
I can invest in Baidu or whatever I want.
And so I probably stepped on the idea, but it makes a case that money always and everywhere finds its best use. Governments and central banks can't do anything about it.
So let the private market create the best goods and services. Let the money find their best route with a healthy dollar. Let the market step in and let the bureaucrats step back. Is that kind of a bottom line here?
Precisely, and if the dollar ever collapses into nothingness, at present it is the world's currency.
Absolutely.
It is anywhere you go, and the countries that hate us the most, the dollar is the currency of choice there.
Right.
And so if the dollar ever collapses, it will be replaced, not just in the United States, but around the world. And that's the book's broader thesis, is that the very correction in crypto that we've been talking about is the surest sign that crypto is going to take over.
Well, I'm a big believer in that. I think that as long as people recognize that a lot of the altcoin industry is garbage, but that you have to look for the valuable 10%, and you have to stay on top of Ethereum blockchain as to what's happening with the Ethereum merge, and that's a whole other show, but I'm with you there. Kind of bringing things into a conclusion here, let's talk to the retail investor. There are folks that are watching what's going on right now, and I think that the typical retail investor is feeling a little bit helpless right now, because every time they look at their computer screen for whatever their portfolio is, no matter how modest it is, they typically see a lot of red on the screen. They see a lot of stocks going down. There's a lot of helplessness and even a little bit of panic going on right now. I'll go ahead and I'll just take a swing at this ball first, but then I'll let you close us out. What can the American consumer and the American investor today do for the next 6 months in terms of asset and wealth preservation. One of the things that I think is really important is for people to avoid the lemming effect. Try to be a little bit of a skeptic in questioning on what you're hearing and seeing every day coming out of the bureaucrats in Washington, because as we've been talking about, there are basic underlying assumptions that are being automatically plugged into the Fed's activities that are making assumptions that we're seriously questioning here today. And I don't understand why a lot of those questions aren't being brought up in mainstream media, but the first thing I think is to question the wisdom of the graybeards that are, or anybody that's on the media talking about just these assumptions on the powers of the Fed. The other thing I would suggest is to hold in your convictions, do your homework and hold in your convictions in terms of your investments. Grab a small bundle of investments, be it whatever they are, even if it's your own business. But just hold on to it and don't get distracted by the noise, because there are so many things that are going on right now. Let me just take one example. In the field of healthcare, in the field of Alzheimer's research, there are so many amazing, exciting things going on, and we're on the cusp of so many potential groundbreaking changes that are going to make the world a better place, that if you know that your money's in the right place, don't get stuck on CNBC or listening to the Kramers of the world. Hold your convictions and continue to study. But John, for those of us who are investors, who are just trying to make their way with some capital preservation, what are some final words of wisdom that you would tell people to focus on instead of just falling into the regular drones?
Well, I broadly agree with you. I mean, I'll just say it what you're saying in probably a slightly different way. Just never bet against the U.S. economy. Never bet against the U.S. economy, because it's full of the most productive people on earth. The noise in the near term, it's always noisy. There's always fires out there. But broadly, the only constant in the U.S. is progress, at which point, don't even bother with the Fed. You're doing for the Fed what it wants by pretending it's relevant. The notion that capitalism won't routinely outrun Washington bureaucrats
Right.
vandalizes basic reason. The Fed is irrelevant, which is why it has to do these things. It's searching for a purpose and it can't find one.
Yeah.
Don't let the Fed impact what you do one iota, because it has nothing to do with what you do. The future is blindingly bright, and it includes lending that's going to get cheaper and cheaper simply because production's going to get exponentially more productive.
I love it. Stay positive, stay focused. You know, one of the a closing point. One of the aspects of a democracy is that democracies and open markets can be noisy. The noise can be distracting, and also in the world of social media can be a little bit divisive. But that's one of the health marks of the open exchange of ideas. And I am very bullish on the United States and on the market, and I'm with you 110% on that. John, we welcome you back from a great summer break, and I'll look forward to our next conversation.
Yes.